When you retire, one of the biggest choices you'll face is whether to take your 25% tax-free lump sum, also called the Pension Commencement Lump Sum PCLS. At first, it sounds like an easy choice. Who wouldn't want tax-free money? But if you make the wrong move, you could end up paying tens of thousands more in tax over your lifetime. In this video, I'll explain how the lump sum works, why many people are better off spreading it out, the common mistakes people make, and also the times when taking it early could actually be smart. Just a quick note, this is not personal financial advice. Everyone's situation is different, so please do your own research or get proper advice before making decisions. And if you find this video useful, don't forget to like and subscribe. So, what exactly is the tax-free lump sum? The rule is that from age 55 moving up to 57 from 2028, you can take up to a quarter of your pension pot tax-free. But there's a lifetime maximum of £268,275, no matter how big your pension is. Once you take it, that choice can't be undone. Any further withdrawals after that are fully taxed as income. The good news is, you don't have to take all the tax-free cash at once. You can spread it out gradually over the years. Let's look at a real example. Sarah is 62 and has a £300,000 pension. She wants £30,000 a year before tax in retirement. If she takes all her tax-free cash up front, she's left with only the taxable part of her pension. At first, she can use her personal allowance of £12,570 tax-free, but the rest is taxed at 20%. Later, when her state pension starts, that will eat up her personal allowance, and then every extra pound she takes from her pension will be taxed. Now, here's a smarter approach. Sarah still takes £30,000 a year, but she does it in stages. Each year, £12,570 is tax-free, and on top of that, 25% of her withdrawals can also be tax-free. This way, she saves about £1,500 in tax every year. Over time, this adds up to a huge saving, and she also keeps her pension pot growing longer. A single person could get up to £16,760 a year completely tax-free. A couple, if their pensions are balanced, could take out more than £33,000 per year tax-free. So, why might you hold back from taking it all at once? Well, one big reason is tax drag. If you take your full lump sum straight away, you'll probably pay more tax later. Plus, taking a big chunk early reduces the size of your pension pot, meaning less income in the future. You also lose the benefit of tax-free growth inside your pension, which can make a big difference over decades. Moving money out of a pension can also expose it to income tax or capital gains tax, unless it's sheltered in an ISA. But ISA limits are quite small each year, so it could take years to move a large lump sum over. And you can't just recycle it back into your pension either. HMRC blocks that. Add to that the fact that most of us now live into our 80s or 90s, and you see why keeping your pot strong for the long run is so important. This is where cash flow modeling comes in. It's basically a way of testing different scenarios to see how today's decisions affect your tax and income for the rest of your life. For example, let's look at a couple using the My Finance Future app. One earns £80,000 and has a £600,000 pension. The other earns £40,000 with a £200,000 pension. They have a £200,000 mortgage at 4%, a £25,000 car loan at 7%, no ISS, and £15,000 in savings. Their current spending is £72,000 a year, and they want £65,000 a year in retirement. Plus, they need £90,000 for university costs for their kids. Now, if they just use lump sums to cover everything, that triggers the Money Purchase Annual Allowance, which cuts how much you can put into a pension each year, drains one partner's pension too quickly, and breaches the lump sum allowance. That plan ends with a big tax bill and a large shortfall. But if they instead take a partial lump sum up front, avoid triggering the allowance, build ISS, pay for university, and balance their pensions better, their tax drag falls and their shortfall drops to £57,000. This shows how powerful modeling can be. What looks smart, like paying off a mortgage quickly, isn't always the best choice when you factor in tax and allowances. Sometimes, though, it does make sense to take your lump sum early. For example, if you worry that government rules might change in the future, taking some of it now could protect you. You might move it into a stocks and shares ISA to spread your risks. If you have expensive debts like a 4 to 7% mortgage or loan, paying those off can give you a guaranteed return, which may be better than keeping the debt. If you have a serious health condition, then taking money earlier to enjoy it could be a better use. And for couples where one partner has little or no pension, moving tax-free cash into the other's pension can mean more tax relief overall. There's also the question of inheritance tax. Once you take the 25% lump sum, it becomes part of your personal assets. If you gift that money, it may be free of inheritance tax if you live for 7 years after giving it away. There are also smaller gift allowances that are free from the start. So in some cases, using tax-free cash this way can help reduce the amount of tax your family pays later. The bottom line is, deciding whether to take your lump sum early is not simple. You really need to model your cash flow and think long-term. With the right tools and planning, you can avoid costly mistakes and make smarter choices for your retirement. And as always, thank you for watching.